Understanding different mortgage types. Buying a new home in the country, suburbia, or the middle of the big city is a huge decision because not only are you putting down roots somewhere completely new, you're also deciding where a big chunk of your income will be going for the foreseeable future. Back in the day, people saved their money until they had enough to buy a house outright. But today, unless you're one of those lucky few who can afford to pay for a home in cash, you're most likely going to need a mortgage loan before they give you the keys to your new house. But what type of mortgage is right for you? Well, that depends on your particular situation. Let's start by saying mortgages aren't one size fits all. And to get the one that's best for you, it's really important to understand what makes them all different. So to keep this simple, let's split this into two sections. First, we'll cover the differences between conventional and government-insured mortgage loans. Then, we'll go over the basics of fixed and adjustable rate mortgages. For starters, there are two types of conventional mortgages. One is referred to as a conforming loan. The other is a non-conforming or jumbo loan. A conforming loan meets the lending limits and criteria for government-sponsored lenders like Fannie Mae and Freddie Mac. That's a maximum loan amount of $417,000 in most locations. However, if you live in select areas of the country where housing is more expensive, the maximum conforming loan limit is higher. On the other hand, a non-conforming loan exceeds the maximum loan limit for an area. Both Fannie and Freddie were established by Congress to help make those home mortgages available to people with low to moderate income levels. Plus, conforming loans can also be attractive because they usually offer lower interest rates. They can also be a good option if you happen to have saved enough to put 20% of the purchase price down, and the amount you're borrowing is under the maximum loan limit for that specific area. Now, if you put down less than 20%, in most instances you'll be required to pay private mortgage insurance. Most banks refer to it as PMI, and it protects them if you default on the loan. It's also usually added to your monthly mortgage payment. Another category of mortgages is government-insured loans. Let's take a quick look at a few of them. First are FHA loans. They're designed to help you purchase a home with a limited down payment amount, and so they appeal to those who might not otherwise be able to secure a conforming loan. So, if you have a lower down payment, or maybe less than stellar credit, ask your bank about an FHA loan, as it just might be what you're looking for. FHA loans are made by private lenders, but are insured by the Federal Housing Administration, which means the government guarantees that the lender gets paid even if the person borrowing the money defaults. But before you opt for an FHA loan, there are some things to consider. Namely, you'll have to pay an upfront mortgage insurance premium, also known as UFMIP, which can be paid in its entirety at closing or rolled into your financed amount. And you'll also be required to make a monthly insurance premium, or MIP, as part of your monthly mortgage payment. Next are VA loans, which are made available to military personnel and their families by the Department of Veteran Affairs. They don't require down payments, which makes buying a home much more accessible for current and former members of our armed forces. But there are fees to take into consideration. VA loans require a one-time VA funding fee, which can be fully or partially financed into the new mortgage or paid at closing. This funding fee, which is non-refundable, is higher when you finance 100% of the cost of the home you're purchasing, but decreases if you put down between 5 and 10% of the purchase price. A third type of government-insured loan is made available by the United States Department of Agriculture. These were created to help if you're from a lower income level and living in a rural area of the country. Now, if you need more in-depth information about these and other government-insured loans, you can always visit govloans.gov for help deciding which one suits you best. Now that you have a basic understanding about conventional and government-insured mortgages, let's get into the differences between fixed and adjustable rate. A fixed-rate mortgage is exactly what it sounds like. It's a mortgage that keeps the same rate for the entire life of the loan, typically 15 or 30-year terms. So let's say you take out a 30-year fixed-rate mortgage with $2,000 monthly payment this year. You'll still be making that same payment of principal and interest 10, 20, and 30 years down the line. In a lot of cases, the longer your loan term, the higher the interest rate. So if you're looking to pay less in interest payments in the long run, choosing a fixed-rate mortgage with a shorter term, like 15 years, could be the way to go. Not only is it possible to get a lower rate, you'll also be paying it off much faster. But it's important to note that there is a trade-off. Your monthly payments will be higher with a shorter-term loan. Then, there are adjustable rate mortgages, also known as ARMs. These mortgages have interest rates that change depending on market conditions, meaning that your monthly payment will fluctuate periodically. The most popular type of ARM taken out today is a fixed-period ARM, also known as a hybrid ARM. They're based on a 30-year term and typically start with an initial fixed interest rate for a specific period of time, usually about 5, 7, or 10 years. For example, a 5-year ARM will be referred to as a 5/1 ARM, and its interest rate will stay the same for the first 5 years. Because the interest stays the same for 5 years, the monthly payment of principal and interest will also stay the same for this time period. But after that 5th year, the interest rate is subject to change annually for the remaining 25 years left on the mortgage. The rate will change based upon changes in the current financial market. And that means that your monthly payments will change based on the interest rate applicable at the time of adjustment. So make sure that you're prepared to make higher monthly payments if interest rates rise. So which of these loan types is best for your situation? Asking yourself some key questions can help you figure it out. 1. Do you want the predictability of knowing what your principal and interest payments will be year after year? 2. Are you planning to stay in your home for a long period of time? And 3. Do you want protection from rising interest rates in the future? If you answered yes to any of these questions, a fixed-rate mortgage may offer you the stability and predictability you need, especially if this home is where you plan on raising your family or retiring. And now a few questions to help see if an ARM offers what you need. 1. Is this a starter home or one that you aren't planning to stay in for a long period of time? 2. Do you believe that interest rates might go down in the future? And 3. Will you be able to afford your payments when the fixed rate period is over and the rate resets? Now, if you answered yes to any of those questions, then an ARM might give you the biggest bang for your buck in the short term. That's because many times the interest rate during the fixed period of the loan will be lower than what you typically get with a fixed rate loan. Regardless of what type of mortgage you look into, your credit will play a big role in getting a loan. First, if you have bad credit, you may have trouble qualifying for a loan at all. Second, the better your credit, the lower the mortgage interest rate you'll get in the end. So, if you're busy rebuilding your credit, it might be worth your while to wait a little longer before applying, because just one interest rate point can mean thousands of dollars saved over the life of a loan. If you're thinking about buying a home, now or in the future, it's important to know the ins and outs of getting the right mortgage. What's more, you need to have your financial house in order before you get started. So work out a budget. Look up current interest rates, run some numbers using an online mortgage calculator, and be sure to be honest with yourself about how much home you can really afford. Because you're not only setting out the welcome mat for a happy home, you're making a financial commitment for many years to come.